Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. No doubt, the talk of the town must be what happened at Jackson Hole. I'm sure many of you would have already read or listened about this, so I'm going to be light on details and concentrate more on our investment implications. Jay Powell started his speech by highlighting that the FOMC's quote-unquote overarching focus right now is to bring inflation back down to their 2% goal. Moreover, he stated that they are purposefully moving policy, quote-unquote, to a level that will be sufficiently restrictive, and that estimates of longer-run neutral are not a place to stop or pause. This last line is really the key to all this. In last Friday's weekly Market View publication, we did note that such hints may risk a shift in market expectations. It is in clear disagreement with the market's pricing of a policy pivot next year. This could push the dollar above its 20-year high and the 10-year US yield beyond its peak in June this year, which was at 3.5%. And all these may cause a near-term pullback in risky assets. Now, we have repeatedly been advising you to be switching out of S&P 500 into global fixed income. And it seems that you would be getting more attractive level in this switch, with the US 10-year yield gaining strength, and it may break above our switching zone between 3% to 3.25%. You should continue be taking advantage of the global yields on offer, which is at a 10-year high. And for equities, we think that interest may be returning to Chinese equities, which we're overweight within Asia ex-Japan, which is in turn our most preferred region. It seems to us that this decoupling of US and China financial markets may be happening yet again. It's been happening a number of times this year. It is something that I highlighted in our Tuesday podcast last week. We talk about the different parts of the economic cycle that these economies are in, i.e., US economy overheating and facing inflation, while China economy appears to be weak compared to expectations, giving room for the Chinese authorities to stimulate. Now, over the last few days, there has been encouraging sign between the US and Chinese authorities in terms of the inspection of the audits of the US-listed Chinese ADRs. And this is an essential step that may avoid the listing of Chinese companies listed in the US. That is a positive piece of news. And moreover, if you look at the earnings season in China so far, overall it's not been great, but the internet giants have beat expectations, and they've shown disciplined cost control and measures to improve operational efficiency. And you and I both know that those are really the bellwether stocks in China nowadays. So that's all for me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.